listening. Yeah, we're live.
So we're live. We're good to go.
Mm-hmm.
Yeah, good morning to Europe. Good afternoon to Asia. I'm very happy to present to you our very first educational piece, in this case on venture capital investing. It is something that that has become very, how would I say, very current for many reasons. People who know us know that we're quite strong on the analysis of long-only investments, index investments, and so on and so forth. But we've realized that there's more and more interest in private markets. And we also see that there's a lot of bad product out there in terms of private markets. And we thought we need to get ahead of the curve, do it right, explain to our clients, to our audience, what is private equity, what are private assets. Well done. And I'm excited to have a very capable team with me today. We have Matt Russell next to me. He just joined VenCap as an investment director. We also have Tim Cruttenden, the CEO and founder of VenCap. He's been in the industry for more than 35 years. I think that says a lot. And they will introduce each other themselves a little more clearly. And then we have Heinrich Riel, the investment director, a gentleman whom I met as part of a German family office network. And that was basically the trigger for the discussion, for the cooperation, and effectively also for today's seminar. But yeah, I don't want to bore you with us. Maybe I hand it over to Matt first to introduce himself a bit better.
Sure, thanks. No, great to be here. A little bit of background on myself. Matt Russell, investment director in the team, joined very recently. Background in terms of career, spent my entire career in private markets. I worked at Partners Group, Northleaf Capital Partners, looking at fund commitments, secondary investments, and direct co-investments across venture capital, growth, and private equity. So I've been able to see the sort of full spectrum, within that kind of PE asset class.
Then Tim, maybe you can say a few words about yourself.
Yeah, sure. Thank you. Thank you, Mario. And thank you to everyone for joining. So I'm Tim Cruttenden, CEO at VenCap. Mario's aging me. I've only been doing this for 30 years, not 35. But it's a long time anyway. And I guess, what's good about that is I've been through the cycles. Venture is a really interesting opportunity over the long term, but in the short term, you have to make sure that you understand and appreciate how markets work, how cycles work, and where the opportunities sit. And going through those cycles, you get lots and lots of lessons. So in a way, you get to benefit from the mistakes I made 25 years ago in sort of learning how we go about venture today.
Yeah, wonderful. Thank you. And Heinrich, maybe you can say a few words.
Yeah, absolutely. So I'm also one of the rookies. I'm only 4.5 years with VenCap now. I'm in charge of fundraising and client services. And before that, I had a pretty long career, unfortunately, a lot of scar tissue here on liquid markets. And what I so appreciate about VenCap and venture capital is just a genuinely interesting asset class. We talk about new technologies all the time. So we talk about what will hit the markets in 5, 6, 7 years ahead from now. And we talk about, in particular, we talk about founders. So we talk about people. So what one has to understand, venture capital, it's all about people. And that is beautiful. And that brought me to the asset class to some extent. And hence, very happy to be here today. And a big thank you also to Mario for bringing us together, and also to Jack, for setting everything up and liaising and helping us.
Yeah, Jack sits behind us here. You cannot see him. He's managing the seminar, and he will come in with slides and whatever we need. So maybe to kick it off, Matt, I'd like to ask you, what is venture capital? I see that a lot of people put everything in the private equity basket. They say, I'm investing in private equity, but it can mean a lot of different things. Maybe you can tell us what is venture capital and what it is not.
Sure. No, I'll make a start on that, and then Tim, Heinrich, please sort of chip in. So I think the way I think about it is sort of, we're talking about equity investing into private companies, and that goes from seed investing within venture all the way through to large cap LBO buyouts. effectively, and everything in between. And so you're thinking about sort of startups, pre-revenue, generating revenues, becoming mature businesses, at the growth stage, and then you're into, fully profitable, cash flowing companies when, they get to that private equity stage. And I think it's absolutely critical that you understand the difference in return profile between the venture capital asset class and private equity. So, maybe I'll start with private equity.
Yeah.
If you look at it on some kind of first principles basis, private equity returns as an asset class follow a normal distribution, which means, the mean and the median are kind of about the same. And most private equity deals deliver between kind of 1.5 to 3 times your capital. And so what is a typical private equity deal? You are looking at, you're looking for profitable, stable businesses. And as a buyer, as a private equity fund, at entry, you are paying a multiple of cash flow in terms of your purchase price, and then you are exiting at a multiple of cash flow. And so the components of your return are effectively the difference between your multiple and profit at entry and multiple and profit at exit. And then, with some cash flow generated in between, you've, usually taken on some debt and paid some of that down along the way. So, because of that, you're looking for, very stable industries in usually quite fragmented markets. So, it's a pretty well-trodden playbook in terms of, typical PE deals are, veterinary chains, dental clinics, insurance brokers, stable industries where there's scope usually to do some kind of M&A along the way. And then from a seller's perspective, in terms of the person that's selling that private equity asset, usually they're the majority owner and they are selling majority shares in the business to the PE firm. So if you think about their motivations, usually they are exiting the business, and so their number one concern is price.
Getting a good price.
As you would understand. I think venture capital is, completely different. You have to turn the whole thing on its head, and you cannot approach VC from a private equity mindset. As I said, private equity follows a normal distribution, and most of your returns will be within that 1.5 to 2.5 range. And so
for our investors, let's say we always look at time-weighted returns. That is like towards 15% over long periods.
Yeah.
Before access vehicle, because normally we need an access vehicle, and that can then shave off quite significant parts of the returns.
Yeah.
So we normally calculate with maybe 12% or so realistically.
Yeah, I'd say about 12 to 15% net usually. And I think because of that, fact that you're focusing on stable businesses and you don't have that massive upside, I think what's critically important in terms of private equity investing is downside protection.
Mm-hmm.
And so, as I said, I think with venture, you have to turn everything on its head. We are, in venture, we are investing in and trying to access category defining companies. So we talk a lot about the concept of the power law. And so,
what is the power law? I keep on hearing this term.
Yeah.
So what exactly is the power law?
So, as I said, private equity follows that kind of normal distribution where if you access a kind of medium quality company or fund, you can get the sort of industry average return. In venture, the majority of venture-backed companies fail. And it's the top 1% companies that drive the top majority of value from the asset class. So what we've seen is that typically, on average, the top 30 exits each year drive the majority of the return from the entire asset class. And if you think about the kind of profile of those very big, successful venture exits and the nature of the technology industry, it makes sense, right? If you think about social networks, software businesses, that power law starts to make sense. You have network effects because the bigger these businesses are, the more valuable they become. And you've got a lot of operational leverage in, software, for example, because it doesn't cost you incremental cost to sell another software license. So with that operational leverage, if you get a leadership role, you end up dominating entire industries, continents, and the whole world, which is why we see these absolutely massive outcomes. And so if you think about it from a founder perspective, if you're building one of these companies, you aren't that private equity seller selling your shares and optimizing for price. You are you're raising primary capital, new money to help build your business into what will hopefully be one of those category defining companies. And what we found is that there are a small handful of VC firms that have been able to kind of consistently access those very best founders over time and generate those massive outcomes. And so that creates a very much a haves and a have-nots within this industry. And because the very best venture firms are oversubscribed, that makes it very hard to access those as a new investor into the asset class. And so, I think a lot of people find it, I think the best way to do that is expressing that through a fund of fund like VenCap, where we have those relationships with those very best firms. In terms of just comparing in terms of returns, as I said, your kind of typical private equity deal return or fund would return sort of around kind of 2 to 2.5 times your capital invested. What we've seen with the very best venture firms over time is, north of 3 times, close to 3.5 times, but only if you get access to those very best firms. Because if you can only access the medium quality venture fund, then it's probably not worth doing.
Yeah, because we're getting bombarded with a lot of great ideas, venture capital managers and so on, but it looks like sometimes you don't even need a license. A lot of people call themselves venture capital managers, and we find it almost impossible to perform a due diligence on these. So what do you think of this industry overall? I mean,
yeah,
many stories sound exciting, and we'd like to invest, but
Do you want me to pick that up, Matt, given I've had 30 years of it? So there was a time, Mario, in the late 90s where everything looked really exciting as well. And we were fairly new to what we were doing, ended up investing in quite a few of these exciting looking firms. And we were geniuses for about 3 or 4 years. And then we weren't. And that was the .com bust, essentially. And, the big lesson from that, sort of playing back to what Matt was saying, is it takes a long time to build a really good business. And ultimately, what you're looking for in venture is what you put in versus what you get out. The stuff in between doesn't hugely matter. And what you saw in 98, 99, 2000 was the stuff in between, i.e. valuations really jumping and then really coming back down to earth. And the realization that only certain entrepreneurs are going to make it. If you forget about all the noise, there's going to be 15, 20 really, really good companies founded every year. And that as we really looked into it, there's only certain VCs that are backing those companies on a consistent basis. And so, to Matt's point, what we try to do is focus our efforts on the VCs that consistently back those leading businesses. And so when you get I look at a time like we've had, maybe you're seeing it more in Singapore now, but I mean, certainly in 2018, 19, 20, loads and loads of VC product out there being pitched, lots of new stuff. And our thinking is fairly clear. As Matt said, a lot of companies don't make money in VC. So the funds you invest in have to access those leading companies so you get a decent return. So we need our managers to be taking risk. We need them to be putting capital into these things that, look questionable at the time, essentially. We're in open AI since 2019. Who would have done that in 2019? We were in the funds that were the first investors in Google at $100 million valuation. Again, people thought that was nuts. You need your VCs to be taking that sort of risk and putting capital in. What we don't want to be doing is taking VC risk. So I want my managers to be taking risk, investing in companies. I don't want to be taking manager risk. So I want to be investing with those funds that are consistently generating good returns. And, it sounds simple to say, but, it's a hard thing to do, to be consistent. There's only a few VCs out there that do it really on a consistent basis, probably about 25 or 30 VCs globally that will consistently access those top companies. And for us, that's important, because if we don't get that consistent performance, that persistent performance, and it's statistically proven that it does follow, then we can't give our investors sort of upper quartile boundary returns. You'll end up as a fund of funds at around the average. And that's, as Matt was saying, is not worth having. You want to be in that upper quartile. So yeah, it really, you're right. There's a load of product, long way of saying there's a load of product out there, and it's all very exciting. But I know from experience and cost that investing in a load of new managers that all look very exciting is not a great long-term strategy. You might be lucky and find one or two that are really good. Chances are you won't.
And what do these companies, these 20, 25, 30 companies do differently from your perspective? Because, we're looking at a global market for companies. How do these great founders and these great VC companies find each other?
It's a hard question to really answer for thinking about how a fund starts. Because a lot of firms, even the ones that are now really established, start with a bit of luck, honestly. You find a great company, a great entrepreneur, you build a great business, and suddenly you'll know. The question is, can you repeat that sort of performance? And the better guys sort of seem to understand what it is about those founders and those opportunities that get them to, and they work really well with those founders. So the founders who, if you're an amazing founder running an amazing company, you'll attract other entrepreneurs who want to come and talk to you. If you're working with a strong, supportive VC, who are you going to tell them to go and see? So you get that, once it gets going, once that flywheel gets going, it becomes a bit of a virtuous circle. And a good VC firm understands that and can take advantage of that. Some VCs get lucky and never go any further because they don't quite get that, don't quite understand that. Often they think the company's a success because of them, as opposed to because of the entrepreneur. The VC's there to help and guide and give money, et cetera, but it's not going to work unless the entrepreneur really pushes it. So the good VCs work well with great entrepreneurs, and they understand that it is about the entrepreneur. You've got to fund them, you've got to guide them, but ultimately they're the people that are going to make the decisions, push the business and grow it. And as we've seen over time, once you get that going, as long as you manage your firm well, then you can carry on getting access to those great entrepreneurs and build a franchise like an Axel Partners or a Kleiner did or a Mayfield has or a Redpoint have, that sort of thing. You could, the other way that we've seen it work, and it has worked, is be Mark Andreessen and start a firm with your co-founder Ben Horowitz, and your brand, your personal brand, is going to bring in deal flow. But again, even if it does, you've got to make it work. If your personal brand brings in a load of deals and 10 years later you've got nothing, then you're not going to be around for much longer. So someone like Andreessen has really made it work. They've used their personal brand to bring in deal flow, but they've really, really helped companies and had some great funds along the way.
It's also interesting just thinking about it from the founder lens in terms of how they think about accessing VC capital. If you think about the type of people that are going to build those category defining companies, I think what they realize is that a dollar from one venture firm is different to one from another. I think a dollar from, no-name venture partners is very different to one of those top brands that Tim described. And I think, that's because they realize that if you have the backing and brand approval from one of those very best venture firms, that helps you hire for your business, helps you get better quality people. It also helps you, sell your product more easily to corporates. If they know you're backed by one of the top venture brands, there's that stamp of validation there. So, again, like Tim said, this, success and association with great deals then creates this sort of self-fulfilling unfair advantage that ends up compounding over time as more and more of the best founders want to take capital from the best firms.
Okay, yeah, that makes sense. So basically, these intelligent founders, they understand their weaknesses and go to these strategic partners to get elevated.
Yeah.
And if they are successful as a business, those VCs, the ones we're working with, will back you all the way through. And again, that's an important point. So you're getting early stage and growth capital from these VCs. So they are there for the long run if you perform. If you don't, then everyone realizes what's going on and they cut the business and maybe start again. So it's really about being able to be there for the journey.
So growth capital, you just mentioned that term, that's to be associated with venture capital, because that's also a part of the private equity bucket, let's call it this way, that's being thrown around. So
venture growth, we would call. So, the way that the venture market works is we're in funds anywhere from seed stage up to, call it growth capital, but it's not pre-IPO capital. It's, a round or two before that, where your seed fund will obviously do the seed, maybe a bit of the A, your early stage funds do the A, B, maybe a bit of the C, and then your growth is doing the C, D, E rounds. And then you're getting into the Coaches and that kind of stuff coming down, the Tigers of this world that were doing those kind of really late rounds. But it's definitely part of what we do. So our program will end up 40 to 50% early stage, 50 to 60% growth stage. There'll be a secondary element to that. So that would be a sort of almost separate pot, a 20% pot. But you can see across the primary stages, that's where we would end up. And the profiles actually in terms of return are not hugely different. The IRRs, as we've seen them, are roughly the same. Obviously, on the early stage side, you get a slightly better multiple. On the growth stage side, you get slightly earlier exits. So you end up with a better return profile in your fund. It's not all about the early stage stuff coming through in year 9, 10, 11. The growth stage exits start coming through in years 5, 6, 7.
Maybe could we go through, let's say, the whole life cycle of such a VC investment? You just mentioned OpenAI, basically the company behind ChatGPT. So how did that work? Because it's now a name that everybody seems to be chasing and everybody wants to buy pre-IPO shares. Actually, earlier today, I got a call from somebody from Taiwan who wanted to sell me pre-IPO shares of SpaceX. So how does this work? Maybe you could explain that to us.
Yeah, OpenAI is an interesting one. Maybe I won't use that because because of the way it got started. It's very different. It was sort of Elon Musk, Sam Altman, some kind of charity and all this kind of. It got started in a slightly odd way. It's become more of a commercial business, and I think Kozler backed it at about $1 billion. So a big number for what was essentially a Series A, a massive number. You rarely see that, and has taken in money since. And some of our VCs have played in the later rounds, but obviously with the thinking that they're still going to multiple from there. Maybe a good example is an AI-related company, but slightly earlier, called Scale AI. So this is a company that did a lot of the tagging around AI when it first came in, so helping teach models what things look like, how it worked. This was very focused initially on automated driving, so working with the big sort of ADAS companies and with Tesla and that sort of thing, tagging what's a pedestrian, what's a bike, what's a traffic light, all that sort of stuff. So that was kind of their initial business. And then that kind of went up, started going pretty well, but then autonomous driving kind of slowed down a bit. But then the LLMs came on stream, and suddenly Scale AI played right into an OpenAI and Anthropic and Mistral, and has seen revenues really jump since then. But it's an interesting setup in the way it got going. So I've heard the founder speak a couple of times. He met one of the Accel GPs way back 2015, 16. The Accel GP thought really, really strong founder. So that's where they start. Really, really strong founder addressing what looks like it could be a really interesting market. No one knows, because this is early stage. This is seed stage investing. No one really knows. Great founder, can see a problem and looks like he's got the right approach to solving it. We don't know. Accel seeded it, and the founders started their business in the basement of that GP's home in San Francisco. So that's kind of, that's genuine VC. I mean, they used to be started in a garage. This was started in the basement of a GP at Accel's San Francisco home. It's probably not as bad as a garage, but it's still a basement. And from there, I think they were there for, I don't know, something like 6 months, grew out of there. Index came in and did the Series A. And between Accel and Index, because they both got early stage and growth funds, they have been involved in every round of that company since. It last raised at a $14 billion valuation, I think, earlier this year. So it's gone from seed in 2016 to a $14 billion valuation in 2024. One of the only up rounds actually we've seen from 2021 to 2024 in terms of increasing its valuation. It will likely be a public market exit on NASDAQ in the next 2 or 3 years. But shows you, that's how VC works. You get in with the founders, you recognize the opportunity, you back them at the seed stage, you continue to back them as long as the company looks like it's going well. You help when it's not. So like I say, when the automated driving market kind of slowed down, then the revenues kind of came off a bit, and then it came into their LLM. So it shows success is never a straight line. You've got to support these companies in the challenging moments if you think they're still really strong and there's a really big opportunity there. So the venture funds have done that. And now they're sitting on an asset that will probably be a $20 to $30 billion outcome in the next couple of years. So that shows you a few things. You get in early, and you get in at a much, much lower value if you're VC. You put your first money in, what's essentially 8 years ago. You're then layering in money as you go along. So the early stage funds would have done that seed round, the A round, the B round. So let's just think about 2 funds, an early stage fund and a growth fund. So they'll have been investing 2016, 2017, 2019, staying with the company. Then the growth money starts to come in 2020, 2021, 2024. And then you might end up getting some pre-IPO money coming in next year, but that probably won't be the venture funds. But you can see the early stage fund will have then drawn capital from us as investors in that 2016 to 18, 19 period. That's still working. The growth funds will have called money. So we'd have done a growth fund in 2019. That will have called money from 19, 21 and 24. That money is still in there working. And then you get the exit when it comes along. Excuse me, my phone's going for some reason. Just try to ignore that for a bit. I can't seem to turn the thing off. So you can see how the money's been layered in. It's still working. It's going to take a while for it to exit. So, the 2016, 18 money is going to be coming out in 2026, 27. The growth money is going to take 6, 7 years to exit. But the profile of the fund is drawdown early on, exits come out slightly later, but the drawdown isn't right at the beginning for the whole fund. It's drawn in cash flows. So it's drawn in increments. Jack, I don't know if you want to share, because if you add all that together at the fund of fund level, you then end up with a cash flow profile It's probably quite important that investors can understand that. So Jack's got a slide that he can just share with you that will show you how, in a fund of funds, a cash flow profile might look.
So basically, a fund of fund buys or provides assets or invests in a group of these venture
Yeah.
capital companies that you've just described.
Yeah, we invest in the VC fund managers. They invest in the companies. So they're going to have so a venture fund will have a series of cash flows. So we as a fund of funds also have a series of cash flows. So if you commit $10 to us, you don't pay in $10 on day one. That gets drawn over a period of time. So the drawdowns are the light blue bars here. So you can see how the fund is getting called from investors. So our fund, as a fund of funds, tends to be quite aggressively called in the first 4 to 5 years, and then will be fully called by year 7. But because we've done some secondary investing, some growth investing, you'll start to get distributions back around year 5, 6. So that's the dark blue on there. And then obviously as you go through, the distributions start outweighing the cool down. So, but what it says is, across our funds, historically, on average, around 63% of the money gets called from investors net. So all the money gets called, but in that time, whilst it's being called, you're starting to get money back. Does that make sense?
Yeah, that makes sense. And do you call money in equal amounts over these 7 years, or how does that work?
It tends to be heavier up front. So obviously, as we're investing, so very first, right at the beginning, very little, because we won't have made any investments. But as we make investments, then the calls start to build. So it's probably heavier years 2, 3, 4. So you might see 20-25% of your money get called in those years. So slow start, slower finish, but that sort of concentrated period, years 2, 3, 4.
You mentioned secondary. What is secondary investing?
Oh, well, I'll let Matt explain that, because that's his key role.
Sure, happy to. Yeah, I mean, we've obviously spent time talking about the primary market, and what we mean by that is kind of committing blind pool capital to funds. But obviously, the life of a fund is kind of 10 years plus. And so, what you see is that, perhaps midway through the life of the fund, once it's been fully drawn and fully invested into a portfolio, people, for whatever reason, may need to generate liquidity for their position in the fund. And so that's created a secondary market from the primary market. And so as the whole private markets industry has grown, that's given rise to a secondary market as people trade interests in funds.
And why would they do that? Normally, it sounds, I mean, if you understand the mechanics that Tim just described, why would you want to sell ahead of the end of the fund?
Yeah, so I mean, it could be a variety of reasons. I mean, it could be for liquidity purposes. I mean, I think that was, that's been a big driver during economic downturns. But also, we're seeing a lot of secondary volume right now. To put some numbers to it, we as VenCap have received about $9 billion of secondary inbound secondary deal flow this year in venture funds. As the IPO market has slowed down, there's less organic liquidity coming out of portfolios. We've seen people need to generate that themselves. There's also portfolio management reasons. People end up, overweight a certain asset class within their portfolio, need to rebalance. We saw, again, in kind of downturns in the past, what people call the kind of denominator effect, where the public component of their portfolio has dropped, which has meant the private piece is too big a share, and so they need to rebalance. And so, I think for us, what makes the secondary strategy interesting is, we can layer in further capital into those very best VC firms. We know
You
what
particularly see it, Matt, don't you, after a sort of boom period like we had in 19, 20, 21, where everyone they think what's happening in 19, 20, 21 is normal, and it isn't, it's abnormal. And that's sort of that's the cycles of the market for you. But people extrapolate out and go, well, if I put it in now, I'm going to get my money back. I can see these big exits coming through, I'll get money back relatively quickly, etc., etc. That's just not how the market works. It takes a long time to build an overnight success. And so you see people just investing more and more and more because they get overexcited by the valuations they're seeing. So they're looking at TVPIs and saying, wow, this is an amazing asset class. It's doing 50, 60, 70%. I must get in. And they start putting in more and more and more. And then you get 22, 23, 24, where exits are a bit slower or a lot slower. And suddenly people start panicking. Oh, I thought I was going to be getting money back by now. Nothing's going public right now. How do I get out? I'm overweight. I need to get some liquidity. And we saw it, like I say, I definitely saw it in the late 90s. I even saw it before the financial crisis. There were a lot of people when the financial crisis hit, slightly different issue around market liquidity, but loads and loads of sellers of venture funds and private equity funds in 2009, 10, 11, because there wasn't a lot of organic liquidity on the market.
And then they typically sell at a discount, from what I understand, right? So it sounds like a festival, right? You get the best managers at a discount. Sounds
hard. I mean, Matt can talk more about. You get a lot of managers at massive discounts. Whether you'd want to buy them is a different question.
So you would only buy those best managers, from what I understand, or would you compromise on the quality of the manager?
I mean, philosophy for us is exactly the same, whether it's primary or secondary. We're all about quality. So we stick to the same managers. We stick to those, making sure we're getting exposure to the very best companies. And, I think we still do get interesting discounts. So we've just closed something at a 25% discount to the valuation mark. So, really interesting from an entry perspective. And also the fact that you get, because you're coming in sort of halfway or 3/4 through the life of the fund, you get your cash back much quicker. And so, as Tim said, we've always done kind of some secondaries out of the fund of fund, which is, I think, the reason behind we've been able to start making distributions to investors in sort of years 3 and 4, which you wouldn't usually get in a pure primary fund of fund vehicle.
Because I thought it would really be stretching to those 10 years. Normally we say venture capital is very long, like the longest duration investment idea. So you're saying by paybacks, it won't actually be that long until people get their money back, at least the initial investment.
Yeah, I mean, I think the bulk of the portfolio will still be primary, so that more kind of long-dated, higher multiple. But I think by having the secondaries and the growth exposure, it means we can start making distributions much quicker to investors. And then, as we said in the slide, you only end up becoming sort of typically 60, 65% net drawn because those distributions start covering your capital calls. So it's
and then you should be fully returned around year 9.
Mm-hmm.
And then the upside comes.
Yeah. So you see around
that's I think, just chiming in here, I think that is a very, very, very important point, right? Because people think about it, they hear about venture capital, oh my God, it's 15 years, they're building companies. And so people typically think they put their money in today, they get the money in back after 15 years, right? That's not true, because you put money in over time, but typically around year 8, 9, if you want to be very conservative, we have already paid back the entire capital that you have committed to the fund, right? And until this year, number 8 or 9, you get regular distributions out of it. So this is why, the cash flow profile, the cash flow chart that we showed to you, you have to look at it and really understand that it's not as bad. So I think you get a regular flow of capital, of distribution back from venture capital.
So I think, actually, I have one more question before we go to the fund specifics. valuation. I mean, now we also seem to live in a time where, yeah, companies like OpenAI or any idea of Elon Musk gets paid very well, and everybody is chasing it. At the same time, certain industries are totally neglected. So how are these great venture capital companies acting at this point in time? How do they deploy capital in the current environment?
Mhm. So early stage, seed and early is fairly consistent in terms, values go up and down a bit. Entry valuation doesn't matter too much at seed and early. It's never that. It's in a band. I mean, other than random, maybe OpenAI, where you've started in a different way. You don't normally get $1 billion Series A. You think back to the big Series A's of the past, Facebook and Google, $100 million valuations for Series A. But look at them both. That worked out. So the sort of seed and Series A kind of investing, I think, is pretty steady, and valuation is less important. Where valuation becomes more important is when you're doing the growth stage stuff. So a lot of our VCs have not done much growth, probably in 22, 23, as they were waiting for valuations to kind of reset. And they've been more aggressive this year as valuations have reset. And you're right, around AI, there's a bit of a frothiness. There's some obviously very high valuations. But generally across the market, across cyber, software, that kind of stuff, valuations have reset quite nicely. And people are feeling confident again in terms of doing growth deals. But you've got to have the capital to do it. One of the big things at the moment is not that many VCs have got the capital to do things. I mean, you're talking about there's a lot of VCs in the market, a lot of exciting opportunities. I bet you not very many of them are getting funds closed. It's really difficult. You wander around Europe, there's a lot of VCs, again, that were started 5, 6, 7 years ago that are not getting funds closed. Had nice TVPIs 4 years ago, 3 years ago, don't have today. Still trying to hold companies at old marks. That's quite a common practice. Again, if you're looking at a fund, be very careful about how they're holding their companies in terms of valuations. Is it last round? Was that last round in 2021? If it is, that's probably not the right valuation. A lot of our VCs were pretty aggressive in writing down early on once we started seeing a correction. So we tend to trust their valuations somewhat more. So I'd say on the whole, it's a better valuation market. It certainly is a better valuation market than it was 3 years ago, but it's a better valuation market now for investing, given there is some frothiness around certain parts of it. And who knows how those ones will come out? What's OpenAI going to be worth? Who knows? It's doing around now, is it 100 billion, Matt? 150, I can't remember the number.
Getting towards that, yeah.
Yeah. But, what are the absolute outlier technology companies worth now? 1.5, 2 trillion. So it's not impossible to see it go there, depending on what your time frame is. Like I say, it's been around it's been invested in since 5 years ago, but it's probably been around 7 or 8 years building the technology. So what could it be worth when it's a 15, 20-year-old company? Could it be one of those ones that is $1 trillion plus? Because if you look at technology, I mean, I think one of the things that keeps us not relaxed about valuations, but less overly worried unless we're in a bubble period, is that tech share of GDP is going to continue to grow. So, I don't know what it is, 30% now. It's going to continue to grow over the next 10, 15, 20 years. So if global GDP grows by 2, 3, 4%, and tech share of that goes up by 5, 6, 7, 8% a year, what are valuations going to look like in 10, 11, 12 years' time? And the answer is probably higher than they are today. So you're getting that, you're getting that kind of tech cycle, tech conversion, digitization, however you want to think about it, playing through into valuations. And then you've got in the background the AI stuff. And again, who knows? But, you know, could ChatGPT be the smartphone moment, the iPhone moment for this sort of technology? Quite possibly. And you've got to be in those sorts of companies to find that out.
And I think, again, chiming in here, I think this is a super important point here, right? If you think what we're talking about here, right? So venture delivers great returns, right? But venture delivers in particular great returns if you have some kind of technological revolution. The last one we have seen that we can somehow compare to what happens on the AI side is when the iPhone was presented in 2007, right? And then also at that time, where the coincidence of new technology, market consolidating, and then massively taking off, right? This is pretty much where we are today. Markets have consolidated. Venture has consolidated. Valuations down 20-25%, like in 2008. And now this massive new technology. And if you look in the performance of venture in the years after 2008, so 9, 10, 11, 12, 14, and so on and so forth, it's absolutely spectacular. And this is a little bit how we view the world today. So this a massive new technology. We shall see what the outcome is, but it's a massive new technology, and the market's still coming out of a pretty substantial consolidation.
I think this is a good segue to now talk about the opportunity, because when I met you, Heinrich, in Hamburg, you told me that normally family offices and institutional investors need to come in with tickets of $5 million to even, so that you even talk to them. Funnily enough, or luckily enough, we're now in a situation where you have a new, let's call it distribution strategy, and you're looking to do more in Asia. Currently, you're not doing anything in Asia, which effectively opens the door to our, to our clients, to our families, to our prospects, to look at serious venture capital. I think that's become very clear that all of you know what you're doing. And I personally feel very comfortable having this seminar and talking also about a specific product. So maybe, maybe now it's time to talk about the fund that we can subscribe to.
So I pick that up.
So yeah, please go ahead, please.
Yeah. Okay. So the fund we have is what we call it's a core manager focused fund. So like I said, mainly primary, 20% secondary. The core managers for us are this group of funds that we invest with on a consistent basis. And as part of our offering, we guarantee that at least 75% of investors' money will go into that core manager group. So I go back to, we want these people to take risk. We don't want to be taking manager risk. So we're going to invest in well-established firms that we've, on the whole, been investors with for many, many years, that we know well, and they've generated consistently good returns. So minimum 75%. I think the last decade, when we look at our core manager portfolio, we're closer to 85%. So again, you can be fairly sure where the majority of your money is going to go. We've already had a close on the fund. So we've closed at nearly $50 million. It's kind of a friends and family close, and we will use that to put together a portfolio of investments, kind of like a warehouse for the fund. So the fund is VenCap 18. By doing that, it then means that when investors come into the fund, when we have a close, there'll actually already be a portfolio there. It'll probably be some primaries and some secondaries, and that very much helps in mitigating the J curve. One of the things people worry about with venture funds and fund of funds in general is the J curve, and we always try to mitigate that by having a portfolio in place to start with. It can be above cost, so that makes it look very nice. But even if it's slightly below cost, you're a period of time through the J curve. So that's actually quite helpful. You're not starting right at the beginning and having to take the initial down. So we try to mitigate the J curve. We have, again, to help mitigate the J curve, we only charge half of our fee on money that we haven't yet committed. So if you think again about our product, let's say we raise $300 million and we invest 100 million in the first year, we'll only be charging full fee on the 100 million initially and a 50% fee on the other 200 million. So we only get to full fee when we're fully committed. And you can see our target returns there, plus minus 20%, depends slightly on cycles, and around a 2.85 net to investors. Our core manager group have delivered about a 3.3, 3.4x net back to us since the very late 80s. So we're fairly confident in that number. Again, it's slightly cycle dependent. We could be in a super cycle right now. Who knows, as AI comes through, so it could be better. You just don't know. So no promises, but that's very much the target. If we go on to the terms, and we've talked quite a lot about that already, particularly the top point. We're 90 bips management fee.
Yeah, I think that's important to highlight how we get from these, let's say, these performance to, let's say, the performance that our clients will realize. And I think fees are a big issue, and I think you're addressing this in a very kind way. 90
Yes.
basis points sounds like a really gentle fee.
Yes, I mean 90 bips on committed. So that's money committed to the funds, and we take it up, I think, on a quarterly basis. So if we only commit 20 million in the first quarter, we're only charging 90 bips on the 20, and let's call it 45 bips on the 280 that's left. So just using that $300 million example as to how something may work. So we build the fee over time. We try to limit that upfront. We try to limit the J curve. We get the net IRR in a better position. And again, these things that we've learned over time, I go back to the 90s and the early 2000s, we had good multiples in our funds, but we didn't have the greatest IRRs because we weren't very good at thinking this bit of it through. We weren't very good at managing cash. We've got better with experience. So we're now in a much, much better place in terms of generating good IRR. We do take a carry based on performance. So we take 5% of profits once we've given 1.5 times your money back. So it's not TVPI based, it's DPI based. You commit 10, we will give you 15 back before we take any carry. And if we give you 25 back, then we would take a 10% carry. So we're very aligned in terms of delivering returns to investors. And that's 1.5 and 2.5 are net numbers. So that's 2.5 has to come back net to you before we get to the 10%. And you can see the impact that has overall on the funds, depending on where we get to in terms of performance, portfolio, and IRR.
And when will the fund close?
Heinrich, do you want to pick that up?
So we had our first closing in August, and then typically the fund stays open for 18 months, which is bringing us somehow into the first quarter of 2026. So we have plenty of time ahead. So final closing somehow first quarter of 2026.
But Heinrich, you were saying that there's also something in December, or has that timeline been moved?
So a little bit. So we have the next closing early January now, and the interesting piece is this will be our first closing for all investors. So we have a fee deal on it, or a fee discount on it. So whoever comes into the next closing, which is early January, will have a 10% reduction on the management fee. So the headline fee, as Tim explained, is 90 bips, which will go down to 81 bips for the entire life of the fund. So pretty good deal if you can make it into our next closing.
Okay. And And let's say somebody commits $1 million. Let's say, at what intervals do you expect this 1 million to be drawn down? So let's say, what would that life cycle be of that 1 million, provided everything kind of goes as it has in the past? I mean, you've done a lot of funds. I think you have a tremendous track record. Maybe you
So
can.
I would say, if for investors, right, to be on the safe side, think about that we will call around 20% every year for the next 5 years. Right? There's a little bit of more cyclicity into that, but if you want to be on the safe side, you say I get called 20%, so I commit $1 million, I have to pay in $200,000 in the first 12 months. Typically, at the closing, we call a little bit of money, like 5% or so of your commitment. But 20% per annum is what you should expect. And then starting, in year number 3 or 4, you should get the first distributions back, small amounts of money, but the first distributions back already from the fund to you.
And you have 2 feeder vehicles. You told me there will be an Asian feeder vehicle, and for European or German investors, there would be a Luxembourg vehicle. What's the difference
Well, let's say
there?
we have 2 vehicles. One is a Luxembourg vehicle and one is a Jersey vehicle, right? The idea is rather to say, the Luxembourg vehicle is for all our international investors, and the Jersey vehicle is more for our UK investors. But both vehicles are open for our investors. For the time being, on our end, there is no preference really, right? In terms now, technically speaking, if you want to differentiate between the two, the difference between Luxembourg and Jersey is that in Luxembourg, with the Luxembourg fund, we have a custodian that you don't have in Jersey, and you have an independent AFN, which is an independent asset manager, right, or the investment manager. But that's more technicality. But for people who say, I want to have a custodian in my fund, then the Luxembourg would be probably the little bit better option. If people say, hey, maybe I'm happy, I feel more comfortable in a kind of a UK legal environment, then the Jersey fund might be the better solution. Performance-wise, no difference.
Okay, sounds good. So I think we can open the floor for questions. I mean, I hope it became very clear to our audience that we found a really good partner in VenCap. My hope is that this will become a program where we can basically say that our families allocate a certain amount of money to venture capital as a strategy, using a fund of fund manager such as VenCap, because I think there's no point ourselves doing any due diligence. We need to delegate this, and I think we found a good partner. Obviously, we're the agents of our clients. We will not collect anything from VenCap or any other product or service provider. So my personal hope, expectation is that this will be done well. It will enhance our clients' portfolios. I will also commit money myself, and that we really can get above that 15% time-weighted return. That would be my personal expectation, because otherwise I think it's no point going into illiquid markets if you don't get paid for via higher returns. I personally liked it when Tim was here in the office a couple of months ago. He told me about his sons, and then he felt that they should be investing in venture capital, but they're too young, so he has to do it for them. But yeah, my comfort level is high. So yeah, let us have your questions.
I think the first one.
Oh yeah, the questions you have
So-
to type in the chat.
Yeah. So the question is, how, as a family office, right? What should be your allocation to venture capital? And of course, that's a question that we get a lot. And what we typically do is refer a little bit to the Yale endowment model, Yale University. And that's interesting because that's actually very comparable to what a family office needs to do. Because first, they need to deliver a regular cash to the university, right? They have a portfolio and they need to deliver like a 5%, 5.25% return to the university. At the same time, they need to grow the asset base. So how do they think about it? The interesting piece is they have a very large allocation to alternatives, like venture capital is the largest allocation, hovering around 40%, and a little bit in private equity, a little bit in hedge funds. But what is really compelling is that they don't really have a fixed income exposure, because they would say, I have like 60, 70% in percent or 6% in illiquid assets. I have 40% in liquid assets, equities. And they would say, if I need liquidity and I can't get it through the distributions from my private equity and venture program, I just sell down my liquid equity portfolio. And their thinking is, if I go into fixed income, the best thing what I get is something like a 5, 6, 7 kind of percent return per annum. If I go into venture, I get 20%. So if I get a venture over 3 years, 4 years, I have made so much money that even if there is a drawdown in venture, I'm still 3, 4 times better off than being in a fixed income asset class. Hence, based on that, our recommendation would be become a regular investor in venture. Don't try to time the market. It doesn't. Generally speaking, it doesn't work. In venture, it doesn't work. There's no asset class. It doesn't work. So be a regular investor, and then always distributions will flow back on a regular basis to you, and which means that you will have distributions, income, you will have capital gains, and depending a little bit on the tax system you're living in, but typically capital gains are always taxed much lower than any kind of income, and fixed income is income.
There's a question for Tim. How much of your wealth would you allocate to venture capital? In
a bit
perspective,
like-
it doesn't have to be sterling or any
No.
currency, just the percentage.
I mean, a bit like Heinrich's point, I'm a big believer in private markets. If you look at the data, buyouts too, private markets do better than public markets. And the comment I was making to you when I was in your office is, where it works, it should be working, is for the youngsters who are doing long-term saving for pensions, because they don't need it. It's that's illiquid capital. Should be there for 30, 40 years. If you can compound at just your average private equity funds, you're looking at 10 to 12% versus what public markets have generally done. A decent venture portfolio will give you probably 12, 14%. I think ours is capable of delivering more than that, and historically has done. So, it's an age profile thing, isn't it? But if I was managing family money and thinking, I don't need this, this is illiquid, this is about long-term wealth, then I'd be, to Heinrich's point, far more in the 30, 40% in private markets. And my preference, because it's what I like, is I would probably be more than half of that in venture. But I've got to be prepared to live the cycles. I've got to know I've got the capital to meet the cool downs. But if you can do that, again, historically, you end up doing much better. You've just got to be prepared to ride through the noise. And if you've got to do it with good managers, if you get, what I know doesn't work is deciding you want to do venture and starting to try to invest directly in companies. That doesn't work, because that tends to happen around frothy markets. People get valuations wrong, or people do seed and early stage investing with a friend because they think, oh, this is a great idea, without really understanding what it takes to properly build a company. It's hard to invest directly in venture funds. You can do it, but unless you're in the top 20, 25, then you're hoping for good results rather than expecting good results, would be my take on that. Whereas I think if you can be in the top 25, 30, you should expect good results, and they should come through. Sorry, long-winded way of saying, I would be quite heavily exposed to private markets, however you want to think about it. And I personally would have quite a lot in venture, but that's because, to my earlier point, I think technology is going to drive economic growth for the next 20, 30 years.
Here's a question. How does VenCap have access to these great managers? Obviously, everybody would want to invest with these great managers. Actually, I've been trying to invest with TCI, a great equity manager, but they don't want our money.
Mhm.
Why do they want your money?
Partly because we're reputationally strong. So we've been in the market, as you said at the beginning, we started back in the late 80s. Dave's our CIO, has been investing in venture funds since 1992. I've been investing since 1994. A lot of these funds we've been with for a long time. Axel since 94, Andreessen since early 2000s, Index since early 2000s. Redpoint since their fund 4, I can't remember when that was. GGV since their fund 3, Spark since their fund 3. So, you know, we build long-term relationships with these firms. We access them, we think, at the right point, which is generally around a fund 3, when you can start separating signal from noise. So you start to see if the VCs are any good. You know, like I say, we don't really want to be taking manager risk on those on fund 1. We can get in around fund 3, and then we're supportive. You know, we know that a good fund manager, if they do their business right, will build out strategies that tend to work. So, you know, with an Axel, for example, we're supportive of their US early fund, their growth fund, their India fund, their Europe fund, all of which have been very, very good. You know, with Lightspeed, we're supportive of the US early, their US growth, their China fund, and their India fund. So we're investing across strategies. We're supportive of them as managers because we can see if they're growing their business in the right way. We know one of the keys to building a long-term venture fund is managing your team, managing succession well. And so again, you see that in the good VC firms. You know, if you looked at the websites of virtually any of our funds, there's very few really old founders still there. You know, a lot of them are the next generation people coming through because the original founders have managed it well. They've got the economics right. They share them. They make sure that they're keeping the right team.
Here we have some questions. PE funds also expect around 15 to 18% returns. Why take VenCap VC risk when return profile is similar to PE? I mean, our data points to realized returns on private equity. I guess that means leverage buyout more in the range of 11 to 12%. But yeah, I don't want to answer the question. What do you?
Yeah, I mean, that would. Yeah, I mean, there's expectation versus reality, isn't there? So a PE firm might expect 15 to 18%, but to your point, what's the reality? So, you know, if you were to put a portfolio together and your data tells you it's 11 to 12%, that tends to be more the reality. So, you know, if you can get 15 to 18% in what looks like a relatively safe way through doing private equity investments, then that's not a bad place to be. I mean, like I say, I think we'll be plus minus 20%. We'll be around a 2.75 to 3x multiple return. You can see the cash flow profile, so you see how it works. The one thing I would say is don't confuse venture and risk, in that we do venture as a fund of funds in, I would say, quite a conservative way. Like I say, our managers, we want them to take risk, but we're not taking manager risk. And if you look at our venture fund profile, Jack, I don't know if you can share the graph that shows the core manager returns since the very late 80s. But I think this should give a degree of comfort that there's not the sort of risk that I think people assume there is if you invest in venture. So, you know, from the very late 80s, we've invested in something like 110 venture funds that have been raised by our core managers. And this bar graph here is the outcomes. So this is 89 to 2019. So, you know, no point having the 2020, 21, 22, 23 numbers in it because they're all going to be around 1x. So they'll just bunch around the low end of the thing because, yeah, they've had no time to really develop. So this is, you know, essentially 89 to 2019. So our approach to venture doesn't hit the upside. So the right-hand side, because these are good managers, tends to take care of itself. Yeah, we're not in funds that do 70x, but they'll tend to be a $25 million fund who gets lucky with one company. But we are in funds that are doing, you know, a decent 8, 9, 10, 11, 12x. We've got a maximum around nearly 20x. Such that the upper decile of our managers is 6.8, the upper quartile's 4, and a median's 2.5. So that's given us an aggregate 3.4 TVPI across this group. But look at the left-hand side. You know, this is our core manager portfolio funds. So not our fund of funds, but the actual underlying portfolio funds. There are 3 funds that are less than 1x. 3. So try and equate that to how you think about risk. You know, there really is very, very limited downside here. You know, the lower decile is 1.3x and a lower quartile at 1.8. You know, a 1.8 is probably where you'll end up with a private equity portfolio, maybe a 2x. You know, we're looking at, on the whole, I think, better right-hand side return, so better in terms of overall growth, but actually with a lot less risk than people think.
We're quite happy to share some information. Let's say the person who asked the question, maybe you can send me an email at mario@dfo.sg, because we have good data about realized returns. I mean, personally, one reason why I was so skeptical on the whole private equity, private asset category until maybe about 3-4 years ago, I made a personal investment in Blackstone 6 that was 70% of the fund in combination with GSO mezzanine and private credit. And only now this will be closed because it's bought by a secondary manager. So it took me about 16 years for this to close. And the IRR, so the time-weighted return is now less than 7. Yeah. So clearly I'm very skeptical. And I know all the prospectuses of the private banks and of all these platforms who are looking to democratize private assets. They advertise these very high numbers, but they do not tally with our research. And I would honestly say, if anybody is looking at leverage buyout, if you're getting a 12% after fees, you have a good result. So be careful if anybody promotes 15 to 18% to you. And that's also the reason why I want to talk about VenCap, because I think for once we have something that may bring us above that 15% hurdle. But I mean, I also don't want to hard sell VenCap. I think it's a great opportunity, and I think it's worth getting your feet wet. But
yeah, and I would say, Mario, I mean, similar to your points, yeah, just be careful what you're being sold, I guess, is the point. You know, I've seen fund of funds out there trying to sell a 4 to 5x. That's not achievable. That is, yeah, that's it. Yeah, that doesn't do the market any good, because you know you just can't do that in a fund, in a venture fund of funds. So you know, look at firms that have been around, look at firms who've got proven returns, look at firms who've been, I don't, you know, in a way, whether it's us or not, if you're going to do a venture fund of funds, find a good one. There's a few out there.
One very important question here is, how long is the management of VenCap committed to continuing with the work that you do? Obviously, it's about experience and the team. So what's your commitment here, time-wise?
I mean, that's a great question, actually, because you know, one of the things we really look at in our VC funds is succession and getting the succession planning right, because you need to be able to manage that as you go through these, because this is a long-term business. You know, if we invest now, VenCap 18, it won't be finished as a fund for 14, 15 years. So that is quite a way out, certainly for me and Heinrich. So what we're doing within the business and have done for years is making sure that the relationships we have with the venture funds are many to many. So it's not Dave and I know the top GPs at Kozler, Andreessen, Index, that sort of thing. Very much, definitely not the way we work. We have a strong group of investment managers coming through. So people like Matt, people like Sean, Jingyu, Alfie, who spend a lot of time going to the LP meetings, mixing with the GPs, the firms we work with, getting to know other LPs, because that's a great network in terms of doing reference work, etc., etc. And you're really building the relationships with the next layer down at the GP, so that as those guys come through and our guys come through, you keep those relationships over the long term. And it's something we've been focused on for many, many years. So like I say, Sean and Alfie already have very strong relationships into these firms. Matt, you've spent a lot of time in the States in the last 12 months, haven't you? Getting to know the managers we work with, getting to understand how they work, building relationships. So, you know, again, a long way of saying we think very deeply about succession within the business, because we know it can't be reliant on myself and Dave and Heinrich. You know, we are all mid-50s. I'm being generous to Heinrich. So, you know, but look, I'm not dead yet. I mean, we're not, you know, there's plenty of life left, and we're all kind of committed to this fund and to getting the fundraising done and getting the investment done. But we are conscious that we need to bring the rest of the team through. And we've been doing that for the last, I would say, 10 years, kind of consciously. And we're probably now actually putting in a more structured process within the business to make sure we've got coverage should anything happen to anybody.
Then here we have a question from a younger investor. He says, when does it become sensible to invest in private assets? How much money do you need to have to even look at this?
I mean, it depends where we go in terms of the, let's call it the democratization. I mean, in Europe now, they're looking at bringing in something called an LTIF, which is actually driven by the EU, to try to encourage almost your average investor into private assets. I think that's quite a hard thing to do, because I'm not sure they really understand it. But back to my point to you, you know, I really think if you're thinking about long-term capital and you have access to long-term capital, then putting it into alternative assets is a good idea if you do it well. So it's hard to do. You know, we've worked with some wealth managers in Europe where people who've got a minimum 250,000 to invest in this asset class can invest. But if you take the view that that should be, you know, 5 to 10% of your wealth that you're trying to build up into that asset class, it tells you how much capital you need in the background to be comfortable doing this. You know, if you're with a private bank, with a wealth manager, I guess there's ways and means of doing it. But it's not really, it's not really for your average retail investor, I guess is what I'm saying.
I mean, we're observing a couple of products where you can invest from as little as $25,000 or whatever currency, but it's not many. So again, reach out to us under my email address, mario@dfo.sg, and we can have that discussion. One question, I guess that's the last question because aware of time. Is there a capacity issue? I mean, you guarantee that 75% of our investors' money will go into the best managers. Will there be a time when you have so much money to invest that it will not flow into the best managers anymore, and that will be detrimental to returns?
Yes, there is a capacity issue. And no, we will not get to at that point, because we are thoughtful about how much we raise. So one of the key things we do when we think about fund size is we are going to tell investors a minimum 75% of it is going into these funds. And therefore, we can only raise X. So we're raising 350 to 400 million for VenCap 18. We think we've got about $400 million of capacity with our core managers. So, you know, if we end up at 354, we'll be very close to 100% invested in the core managers. If we end up at 450, a bit more, then we'll be closer to the 85%. So we're not trying to, one of the reasons we don't go out trying to raise $1 billion plus is we know that it doesn't work. Yeah, if we'd end up putting less than half of it into what we call our core manager product, then we'll end up diluting returns. Where we have an opportunity, we think right now is the secondary side of things. So you could end up doing more around secondaries that are core manager or close to core manager. That gives you extra access. And we can see that part of the market growing quite substantially over the next 3 to 5 years. But on the primary side, no, we're very conscious of capacity. It's the USP for our business. We are telling people this is where we're going to put your money. This is a core manager focus, and we will stick to it.
And no, there's one more
Mario,
question. Should
this
one
one, like this
contemplate?
one about
Okay,
the
sorry.
shift from real estate into venture, right? It's a good
saw
one,
that.
right?
Okay. Mhm.
Yeah. So, I think in terms of asset allocation, it's always difficult to say because it all depends on your personal circumstances, right? But conceptually, again, going back, Google the Yale endowment model to get a little bit of sense, how long-term looks like. But you say you go a third for real estate, you go a third for private equity venture, or let's say venture, and you go a third for whatever else it is, right? Why not? That sounds to me like a decent approach, but you need diversification in your portfolio. Private equity venture is equity. In the end, it's equity ownership, right? Liquid, illiquid, right? Then that's one piece of risk element. Then real estate would be another piece of risk element, and you have to really piece it together that it fits your needs. But the main point we want to make is that when we discuss with family office about their asset allocation, what we see is that the illiquid part is like 20% and the liquid part is 80%, as if they need to get liquidity out of 80% of their portfolio every day. And this is typically not the case. Now, if you think you might need 80% liquidity tomorrow morning, then don't do venture because there's no liquidity, right? But at the same time, if you think, I might need 10, 20, 30% of liquidity tomorrow morning, then liquid equity markets are got a good solution. There's always liquidity there, but still then there's plenty of room for the illiquids, where you get so much better returns, and then venture and also some forms of real estate seems to me very, very decent.
Okay, here's one more question about real estate in Germany. Yeah, I don't know. The question was about apartments. I personally am a seller of German apartments. I think there's no, unless you have a specific opportunity, I see no I see no German apartment that could compete with these target returns. But again, we can discuss this on a bilateral basis. I've been investing in German apartments in the early 2000s and all the way to 2016. And luckily that worked for me and helped me tremendously to become independent. But I would currently not touch it. I'm a seller of German properties, if that helps.
If it helps, even I've picked that up, and I know nothing about German apartments. But when I've been marketing in German with Heinrich, people have said, "God, yeah, I've got these apartments. I don't know what to do with them." Anyway, that's just an aside.
Okay. Yeah, thanks a lot, everybody. I really appreciate the active questions. Get back to us on specifics on the fund mechanics. I truly believe we have an opportunity here to introduce our families to an intriguing asset class and via a vehicle that looks very, very promising from my perspective. And I hope that as we sit around here, we can have regular updates once every year and really see these realized returns in our client statements. That'd be awesome. Thanks a lot, everybody.
Cheers. Take care.
We will be good stewards of your capital. Thank you so much. Cheers. Bye-bye. Bye.
Bye.